Have you ever wondered why your investment account isn't growing as fast as you expected? The answer might be hidden in plain sight, and it could be costing you a fortune. So, before this turns into a regret, think twice, Tony. You see, for most of us, when we think about investing, we think about the exciting stuff, like, oh, I'm going to pick this hot stock, or this fund is going to make me rich. But what often gets completely overlooked are the silent, invisible assassins of wealth. I'm talking about investment fees that just quietly nibble away at your returns year after year until you wake up one day and realize a significant chunk of your potential fortune has just vanished. It's like that leaky faucet in your house. One drop isn't much, right? But over months, that drip, drip, drip adds up to a surprisingly large water bill. Or think about buying a great deal printer. You get it home, you're all excited, then you need to buy ink cartridges, and suddenly they cost more than the printer itself. Those are the hidden fees of the printer world. And in the world of investing, these ink cartridge fees are even more insidious because they're often expressed in tiny percentages, seemingly insignificant at first glance. But they compound, just like your returns are supposed to compound. Let's dive into some of the most common invisible drains that you absolutely need to be aware of. The first big one, and this is a monster, is the expense ratio. This is primarily found in mutual funds and ETFs, which are popular investment vehicles. An expense ratio is essentially the annual fee that all fund investors pay to cover the fund's operating expenses. Think of it as the fund's rent, salaries for the managers, trading costs within the fund itself, and all that administrative jazz. It's expressed as a percentage of your total investment in the fund. So, if you invest $10,000 in a fund with a 1% expense ratio, you're paying $100 every year, whether the fund makes money or loses money. Now, $100 doesn't sound like much, right? Over a year, it seems insignificant. But this is where the magic, or in this case the tragedy of compounding, really kicks in. Let's say you invest $10,000 and it grows at a hypothetical 7% per year before fees. If you pick a fund with a super low 0.1% expense ratio, your effective annual return is 6.9%. After 30 years, that $10,000 would grow to roughly $72,500. Not bad, right? That's the power of investing. But now imagine you picked a seemingly average fund with a 1% expense ratio. Suddenly, your effective annual return drops to 6%. After 30 years, that $10,000 would grow to about $57,400. That's a difference of over $15,000 for doing absolutely nothing differently, just picking a slightly more expensive fund. And that's with just $10,000. Imagine what happens if you're investing $100,000 or $1 million over your lifetime. Those invisible fees become very, very visible over time, eating away at your future. It's truly shocking how many people simply glaze over this number, thinking 1% is nothing. The next big fee to watch out for, especially if you're working with an advisor, is advisory fees. Financial advisors provide valuable services, don't get me wrong. They can help with planning, taxes, estate planning, and keeping you from making emotional decisions. But you need to understand how they are getting paid, because it's not always transparent. Many advisors charge a percentage of your assets under management, or AUM. This could be 0.5%, 1%, even 1.5% annually. Let's say you have $1 million with an advisor charging 1% of AUM. That's $10,000 a year straight out of your portfolio, every single year. Again, compound that over 20, 30 years, and it's an enormous sum that could have been working for you instead of going to fees. Now, an advisor might be worth it for complex situations or if they genuinely provide value far exceeding their fee. But for simpler portfolios, a lower-cost alternative like a robo-advisor, or even managing it yourself with low-cost index funds, might save you hundreds of thousands over a lifetime. Then there are trading costs and commissions. You might be thinking, but Tony, I use a commission-free brokerage. And that's great. Many brokerages have indeed eliminated direct commissions on stock and ETF trades. However, commission-free doesn't always mean cost-free. brokers still make money, often through something called payment for order flow. This means your order might not always get the absolute best price available at that exact nanosecond, because your broker sells your order to a high-frequency trading firm. The difference is usually tiny, fractions of a penny. But again, millions of trades, millions of investors, and it adds up to billions for the brokerage. For the average long-term investor, this might not be a huge deal, but it's an invisible cost you should know about. More impactful are the internal trading costs within a fund. Even if your ETF is commission-free to buy, the fund itself incurs trading costs when its managers buy and sell underlying securities. These costs aren't explicitly listed in the expense ratio, but they subtly reduce the fund's overall performance. Funds with high turnover rates, meaning they frequently buy and sell assets, tend to have higher internal trading costs. So a seemingly low expense ratio might not tell the whole story if the fund is constantly churning its portfolio. This leads us to the narrative anchor for our story. Meet our friend, let's call him Alex. Alex had saved up a good chunk of money and was ready to invest it for his future. He was excited, reading all the articles about the next big thing, and saw a really flashy fund advertised. It had impressive past returns. Of course, they always highlight the good years, right? And the marketing materials were slick, full of confident-sounding jargon. He was almost ready to click invest on this exciting opportunity. But then, a little voice, maybe like ours, whispered, "Think twice, Alex." He remembered hearing about invisible fees and decided to dig a little deeper, even though he just wanted to get started. He found the prospectus, a notoriously dense document that most people skip. He scrolled down past all the legal disclaimers and definitions until he found the fees and expenses section. And there it was, an expense ratio of 1.25%. He also saw a 12B1 fee, another sneaky marketing cost, of 0.25%, and then a load fee of 2% to actually buy into the fund. Suddenly, that hot fund didn't look so hot. When he added up these costs, he realized he'd be paying close to 3.5% of his money in fees just in the first year. That's before the fund even made a penny. He decided to look for a similar fund, an index fund, tracking the same market but with a much lower expense ratio. He found one for 0.05% with no load fees and no 12B1 fees. The difference in future wealth was astronomical, purely because he slowed down and thought twice. So how can you avoid these invisible drains? Here are some decision filters to help you think clearly before you move your money. First, always look for the expense ratio. For mutual funds and ETFs, this is usually found on the fund's fact sheet or prospectus. Aim for funds with expense ratios below 0.2% for broad market index funds. If it's higher, especially above 0.5%, you need a very, very good reason why you're paying that much. Second, understand your advisor's compensation. Ask them directly, how are you paid, and what are all the fees I will be paying, both to you and within the investments you recommend. Prefer advisors who are fiduciaries and charge a flat fee or an hourly rate, as this often aligns their interests with yours. Avoid those who earn commissions on the products they sell you, as this can create conflicts of interest. Third, be skeptical of front-loaded or back-loaded funds. These are fees you pay either when you buy the fund, front load, or when you sell it, back load. In almost all cases, these are completely unnecessary and just eat into your principal or your gains. Many low-cost index funds and ETFs have no load fees at all. Fourth, opt for simplicity. Often, the simplest investment solutions are the best. Low-cost, broad market index funds or ETFs from reputable providers like Vanguard, Fidelity, or Schwab tend to have minimal fees. They track an entire market like the S&P 500 rather than trying to pick individual winners, which is incredibly difficult and expensive. And finally, read the fine print, or at least the summary. Even if it's boring, skim through the fees and expenses section of any investment you're considering. It might take 10 minutes, but those 10 minutes could save you tens or hundreds of thousands of dollars over your lifetime. Remember, the investing world is designed to make money for the providers, not just for you. They rely on you not understanding these nuances, on you being too busy or too trusting. But once you're armed with this knowledge, you can protect your wealth from these invisible drains. It's not about beating the market every single year. It's about letting your money work for you effectively and efficiently without unnecessary leakage. So, next time you're looking at an investment, whether it's a mutual fund, an ETF, or even just hiring an advisor, slow down, ask the right questions, and truly understand the costs. Because the money you save from avoiding these invisible fees is money that stays in your pocket, compounding for your future. And that, my friend, is a much better story.